if the US dollar goes into a destabilizing decline and we start seeing the Treasury auctions tail on a sustained basis, that'll be the early signposts. I think that the odds-on bet is that we're going to have split government, which means that the fiscal spigots will not be turned on as much. And it has to be recognized that it's not just the fiscal support, ongoing fiscal support and government influence on these GDP numbers, both directly and indirectly. But something else that happened along the way that prevented the recession from taking hold. But my motto is, delayed is not the same as derailed. And it's because everybody locked in at those interest rate lows in 2020 and 2021. So what that means is whether you're a corporate or you're a consumer, you did get a get-out-of-jail-free card for a period of time because the Fed raised rates 500 basis points and people are astounded that it didn't even have a barely perceptible impact on the economy. But that's because debt service charges were held at bay because everybody had locked in. But you're not locked in forever. And right now, the Fed is sounding a little less dovish than they were before. And at issue here is we have a funds rate of 5%, but the average of the past 5 years is closer to 2%. That's a 300 basis point gap between the current Fed funds rate and where the normalized level was over the course of the past 5 years, before COVID, during COVID, post-COVID. And if you look at the wide gamut of interest rates that households and businesses are paying, is about, again, a 200, 300 basis point gap. In other words, if interest rates don't come down at the time of renewal, rolling over that debt, there's going to be a huge crunch to debt service costs that we haven't seen yet. The operative word being yet. That still stares us in the face, but it also tells me that to avert that calamity, the Fed is still going to have to cut rates substantially. But right now, because what they focus on, GDP, non-farm payrolls, they're going to drag their heels. But there's no denying where these households and businesses took on this debt, and the interest rate they're carrying is 200 to 300 basis points below the current spot rate, no matter what you're looking at, corporate or household. So that is still a big question mark over the economic outlook that's still out there, because there will be the pain, you see the pain that Jay Powell talked about when he first started raising rates in March 2022, all of a sudden no pain. Well, then the analysis shows how many people actually locked in. But they're not locked in forever. There's going to be a payback at some point, and it could be as early as next year. So as I said before, I feel much like I did, back in 1989, the Fed started hiking rates in the winter of 1988. Where's the recession? Well, started July of 1990. Back in 2000, where's this recession? Where's this recession? Well, started March of 01. 2007, where's the recession? Where's the recession? The Fed actually started raising rates in that cycle in the summer of 2004. 05, no recession. 06, no recession. We get into 07 and everybody once again threw in the towel. Then lo and behold, we had a spectacular recession starting in December of 07. So sometimes the lags just take a long time. And there's been periods in the past where those lags between when the Fed first starts raising rates to the eventual NBER defined recession is 30 to 40 months. And we're heading into that zone right now. And what caused the lags to be longer this time around was, we said, government, fiscal policy, the spending, the excess savings being spent from the stimulus checks. That was a Energizer Bunny gift that kept on giving. And of course, the fact people had locked in. So that clogged up the policy lags. But they're still there. I'm amazed the Fed has stopped talking about it, but those lags are still there. Mm-hmm. And it just reminds me most of 2007, because back then the lags took so much longer, because till the bitter end, even with the run-up in interest rates, remember the Fed took the funds rate from 04 to 06 from 1% to 5.25%. It was almost as pernicious a tightening cycle as this one, and right till the bitter end, what was the offset? Was the ongoing ability and willingness of the household sector to extract equity out of their homes, right till the very end. Cash out refinancings, yes. Mortgage equity withdrawal, what we used to call MU. And what's interesting is that the consensus did not start to call for recession until the summer of 2008, in between the time period that Fannie and Freddie went into conservatorship and the time that Lehman collapsed. And then people were surprised in December of 08 that the NBER had the temerity to date the recession to December of 2007. Why? Because of all the downward revisions to the data. Mm-hmm. And we haven't seen all the downward revisions to the data. We just know, looking at non-farm payrolls, which again is the holy grail for all the employment indicators people look at, they've been revised down in the past year 75% of the time. So the NBR waits for all the revisions because what you see in time A is not always what you get in time Z. And then when you think about it, it was not the financial collapse that caused the recession. The financial collapse really began with Bear Stearns in March of 08 and then culminated with what happened in the summer of 08, September of 08, with Lehman, NAIG, and Merrill. The collapses didn't cause the recession. The recession caused those financial collapses. By virtue of the fact that what do recessions ultimately do? They dry up cash flows needed to service the debts. And I don't think that's going to play out differently this time. I am not a new era enthusiast. I don't believe in new era thinking. I do agree that every cycle has its own peculiar characteristics, but I do think that patterns reemerge time and again. And there's a reason why every recession in the post-World War II period was presaged by a Fed tightening cycle that not only raised interest rates, but inverted the yield curve. And then we have to assess in current time, what are the factors that are acting as antidotes to the damage the Fed has done? And so that's what we're talking about on this call. And that's what I was talking about in 07, where I said back then, and I'm telling your viewers today, delayed is not derailed. And so this is not a deliberate attempt to be stubborn. Why I'm not throwing in the towel is because even though it's taken a long time for the recession call to take hold, I still see those pressures coming down the pike, and it's very difficult to time. But the recession that I thought we were going to get this year probably has been delayed to next year. The recession that I thought was going to take place in 06 finally took place by the end of 07. And then by the end of 07 into 08, people forgot that Rosenberg was early on his call. By the summer of 2001, people forgot, Rosenberg was too early calling for this back in 2000. So I'm really to a fault, but that's because I spend most of my time trying to protect people from the other side of the cycle, which always happens. To tell me that the business cycle has been repealed, you might as well tell me, that the earth is flat and the sun is not going to shine in the morning. The business cycle has not been repealed. This is still an inherently interest rate and credit driven economy, and we just haven't seen the full lags play out yet, but I believe strongly that we will. One thing that COVID changed was the response rate to the initial data on everything. And remember that whether it's employment or whether it's retail sales, we're operating off of a first sample. And when it comes to, say, the non-farm payrolls, remember it's a payroll survey, it's a survey. And it's taking small businesses time to catch up to send their numbers into the BLS. So there's lots of guesswork. It's interesting that in the ADP numbers, small business employment is down 2 of the past 3 months. And they're getting increasingly late in getting the data in, but then they eventually will get the data in. So there's a lot of guesswork, more guesswork than normal in those non-farm payroll numbers. And I tell everybody who's willing to listen, do not trade off these numbers, because you probably think you're right. You're going to be right 3 months later, but on time X where it matters, you're going to be wrong. And the 10-year treasury note yield is going to be up 15 basis points. And then when you go to your clients 3 months later and say, look, I was right after all, look at the downward revisions, they're going to say, well, so what? What have you done for me lately? The response rate for the payroll survey is down to almost 40%. So that's what we're dealing with. The error term, the sampling error term, has rarely, if ever, been as high as it is today. That's why we're getting a lot of these revisions, because with the revisions comes, the new information that the BLS didn't have at the time that they issued the initial report. Very wide error term around these numbers. And then the other thing we have to consider, if you believe in the veracity of the September payroll report, you have to ask yourself the question, how could we have hired net 254,000 people in that survey, and yet businesses cut the work week by 0.3%. So let me get this straight. I'm going to hire you and I'm going to cut everybody's hours. How does that work? How is that even rational? You see, what was interesting to me in that employment number and why I wasn't cheerleading from the sidelines was the most important metric coming out of the data is what's called the index of aggregate hours worked, which is not just bodies, but hours. Like if I hired you and I said, I'm going to hire you not to do anything this month, where's the economy going? Oh, I hired you. That's nice. And you're idle. In actuality, what happened was that the decline in hours worked was so significant that it offset the headline increase in the body count. So the index of aggregate hours worked actually declined 0.1% month over month. Actually, the index of aggregate hours worked, which is important because it is total labor input into the real economy, has been completely flat over the 6 months to September. So knowing that, how do we get lulled into the consensus view? And the consensus is entitled to its view, but how do we get enticed into that view knowing that total labor input, hours and bodies together, have flat over the past 6 months? So everybody is focused on the bodies, but they're not focused on the fact that the work week, which has been cut to 34.2 hours, which, by the way, is the same level that presaged each of the past 3 recessions. So as I dig deeper and I sort of scratch the surface with my fingernails and I see what's underneath, it's not ratifying what the consensus view is on the economy. And it's not ratifying this 3% growth we're seeing in real GDP. Not that I believe in conspiracy theories. I'm just saying that I'm not seeing validation in other sources. But I'll tell you something else, which is the symbiotic relationship between the equity market and the economy. And you'd say, well, the equity market's telling you that the economy is booming. If you look at the equity market, you'd see, well, the surge in equity wealth for a certain strata of the population, people are seeing their 401ks grow like Jack and the Beanstalk. So if you're saying, well, my portfolio is expanding and I have a lot more confidence in my retirement savings, I can spend more of my current income. And that's also what's been happening for the economy, is the decline in the savings rate in support of consumer spending. And the question is, and it's a symbiotic relationship between the equity market and the economy. They both drive each other. But what has me a little concerned is that earnings growth is actually slowing. Now, the pundits on Bubble Vision will say, well, we're at an earnings-driven rally and corporate earnings are still rising. Yes, indeed. Corporate earnings, third quarter, tracking 5 to 6% year-over-year growth. The S&P 500 is up 34%. It's like, call it 7x. So what's happened here is we've had a gigantic expansion in the market multiple. The forward PE multiple has gone up 4 points in 12 months from 18 to 22. So this is not an earnings-driven stock market any longer. If it was, the S&P 500 would be at 4,600, not 5,800 and change. That's just the math. Most of this market move has been the multiple expansion because of the exuberance and the excitement and the confidence that investors have over the landscape. So I would just submit to you that one of the principal risks to the bullish view on the economy is what happens if the movie, for whatever reason, it could just be simply mean reversion of the multiple. You know, the long run PE multiple is 16. We're at 22. You don't want to know where the market goes. If we ever did face the Bob Farrell classic rule number 1 of the market rules to remember, mean reversion of the multiple would be very painful unless we had an unremittent earnings boom. But we know that earnings are slowing actually, and that fourth quarter earnings estimates by the consensus in 2025, earnings estimates by the consensus haven't budged in months and are actually starting to roll over. So I find it just very fascinating, and it's human nature that at the end of last year, the consensus for the S&P 500 for the end of this year was 4,850. We're 1,000 points above that. And of course, the consensus playing catch up and marking the market share projections is now at 5,600 on its way towards 6,000. Because you have to play catch up. But does it make sense? A 22 multiple from an equity risk premium perspective makes perfect sense when bond yields are 1 to 2%, which is where they were a few years ago. They don't make sense when bond yields are 4% plus. The equity risk premium is a razor thin 45 basis points, whereas the long run norm, going back to Bob Farrell's rule number 1, is closer to 300 basis points. So God forbid if the equity market ever realized the extent of its current excessive overvaluation, or to correct that overvaluation for whatever reason, we would have a very big negative equity wealth effect on spending, and the savings rate that's only been coming down. Remember, it started before COVID, it was 10%. Now, even after the revisions, it's 5%. I'll tell you that is, I think, the principal risk is what a bear market in equities for whatever reason. And I'm very concerned about the valuations right now. You know, people say, well, valuations only matter when they matter. Yeah, by the time they matter, it's an elevator going down. You know, there's a lot riding on this because nobody has rebalanced their portfolios in this bull market. You know that in the past 5 years, the stock market has practically doubled and it's up 34% in the past year. But because there's fear and there's greed and there's greed and there's fear, these primal emotions, nobody has rebalanced their portfolio. Nobody has taken profits. Diversification has become a dirty word in the financial sector vernacular. And so we have a situation where over 70% of the household sector asset mix in the United States is in equities. 70! Unprecedented. But I'll just say that 70% for the aging but not aged boomers. I'm one of those. Aging, not yet aged. People over the age of 65. 60% of their asset mix is in equities. It should be between 30 and 40%. Nobody has rebalanced their portfolio. They are all in. And everybody's got the new era secular bull market thinking, and that there are no such things as recessions anymore. The business cycle's been repealed. And I get really nervous. You know, maybe I've just read Benjamin Graham's Security Analysis, and maybe I've read Charles Mackay's Extraordinary Popular Delusions and The Madness of Crowds. Maybe I've read those books far too many times. However, they keep me grounded, especially today when I go to the circus and the stock market's become a circus and I see the clown blowing up the balloon bigger and bigger every single day. But we know what happens to a balloon. This is the biggest price bubble in the stock market since, well, only two other times historically, 1929 and 1999. And in 1929, Irving Fisher famously said that the stock market has achieved a new and permanently higher plateau. And that's really the mentality.